In this video, we're going to talk about 9 myths that all of us need to kill if we're going to build wealth over time when it comes to investing. You ready? Let's go. What's going on, guys? It's your boy Kalechi, and we're back with the video. And we're going to start with myth number 1. You have to be rich to start investing. Wrong. Investing is how you become wealthy. Here's a simple way for you to understand this. If you save $200 over 20 years, you save $200 a month over 20 years, you've saved yourself just about $51,000. Congratulations. That's actually a really good job. However, if you invested that money just in the stock market and getting the average return of about 8%, you would come out with almost $110,000. This is the difference that compounding and investing makes for you. You don't have to work as hard for your money. Let your money do all the heavy lifting. So no, investing is not for those who already have money, to help you grow your money. Moving on to myth number 2, which is investing in the stock market is just basically gambling. The stock market is just a glorified casino for all those rich folks that should be investing. Again, wrong. Now, of course you can turn it into a gamble if you're doing short-term bets, and if you're doing all the things that you see on Wall Street bets, or if you're just following along with what the hottest trend is right now. Of course, at that point, you're turning the whole thing into a gamble. You don't know what's going to happen. But here's the difference between the stock market and the casino. The casino, the house always wins. In the stock market, depending on your time frame, you will always win. So look, if you want to invest, always think long term. Do not look for short-term gain. Do not look for a short-term profit. Wealth is built over time. It is not built in the blink of an eye. Even despite everything that we've seen in 2020, 2021, with the craziness that we have seen, wealth is still something that you build over time. It's not something that just happens at the snap of a finger. Myth number 3, once you embrace the first one of, okay, I don't need to be rich to invest, and then you go to the second one of, okay, I'm gonna have a long-term view of my investment, there is one myth that tends to trip a lot of us up, which is, I need to be smart to know how to invest. Again, wrong. The truth is, the smarter you are, the more likely you are to make some dumb mistake because you overthink everything. Like Warren Buffett said in this clip.
I tell people, if they're going in the investment business, if you got 160 IQ, sell 30 points to somebody else because you won't need it. I mean, I figured out very early, you don't have to be that smart in this business, which is fortunate, but you do have to have the right temperament.
You don't need to be a genius to invest. As a matter of fact, it's actually a lot easier for most people who don't know a whole lot about investing to stay invested because they don't have all this noise going on in their heads all the time. For most people, just dollar cost averaging into a total market index fund is all you need to do for the long term. You don't need to be a genius to get started investing. And that leads us to myth number 4. There's this belief that wait until the dust settles. Wait until the panic in the market is over. Wait until everything looks clear. Wait until everything makes sense. Wait. Just wait. You cannot invest when there's fire on the mountain. You cannot invest when everything just seems to be all over the place. Again, wrong. The best time to get invested is actually when everything seems risky. Is when everything seems like, oh my God, it's never going to go back to normal ever again. Some of the best investments that's ever been made, if we go back to Warren Buffett, he made some of his greatest investments when everybody else was like, we're not doing it. We're out. We have to sell out. We have to panic. Best time for you to invest is not when things are great. The higher the stock market goes, the more risk you take on as it goes up. The best time to invest doesn't necessarily mean that coast is clear and everything's going to look good. However, that leads us to myth number 5, which is, if that is the case, then I need to know exactly when to do, and I need to time the market to actually make money investing. Again, wrong. When it comes to investing, time in the market is much better off than time in the market. And you can check out this video right here to see exactly how that plays out. Investing is not about you being the best time picker. Investing is staying the course. Again, it goes back to the idea that I said earlier on. The longer you are in the market, the better it will be for you. And that leads us to myth number 6. This one is really for all my smart people out there. This one is for all my people who want to be baby Buffetts, who want to say that they're value investors, who want to be like, they want to tell you how reasonable they are when it comes to investing. And that is waiting for things to normalize. This is the idea that everybody likes to push out there, is like, there's always going to be a reversion to the mean. But the fact is, the market is never in a state of normalcy. The market is either high or it's low. There is no time that the market is just like, yeah, we're just gonna rock along with this normal bend. No, the market is never in a state of normal. It's either going to be extremely exuberant or extremely fearful, because everybody's freaking out, because the market is run based off of human sentiment, and how humans are feeling in that moment is what you're going to see in the market. So no, normal is not something you should ever expect in the markets, which leads us to myth number 7, which is just because the market is hitting all-time highs does not mean that we have an impending crash coming around the corner. Most of the time, all-time highs beget all-time highs. And so don't limit yourself just to believe like, oh, we hit an all-time high, therefore the market must be due for a crash. No, that is not always the case. Most of the time when we hit all-time highs, the market pushes on to hit more all-time highs. And now moving on to myth number 8, where after you've done a boatload of research and you understand the things of the stock market of, I'm not gonna try and time the market, I'm just gonna be in the market. And now you get to the level of like, yo, it's time for me to start picking stocks. There's a trap that usually starts off for a lot of us who try to be reasonable about the way that we approach stocks. And that's what I like to call the dividend trap, the high yield dividend trap. This is the idea that if a company is paying out high yields, it must be a safe investment. It must be a good investment because I'm getting paid for what I own. And we can just use the example of AT&T. One of the worst investments that you could have made, and a lot of people made that investment into AT&T. Why? Because it was paying like a 7% yield. It was paying a 7% dividend to its owners. By the way, for those who don't know, a dividend is just a share of the profits that's paid by a company to its shareholders. When you invest in single stocks, do not focus on just chasing high dividend yield. I just dropped a video, you can check it out up here, where we talked about this exact topic. There is a thing where we start dividend chasing. Do not do that. Just because a company has a high yield does not mean it is a good company. Most of the time, a company that has a higher yield is probably, you need to dig deeper and be like, how are you able to pay out that yield? There's a problem there, because that should not be happening. The last myth that each and every single one of us needs to break and needs to make sure that we never allow to creep into our minds again is the myth that risk is the same as volatility. Is believing that the market going up and down, up and down, up and down, up and down is the risk involved in the market. Not so. Risk in the market is you not knowing what you're doing in the markets. So we go back to the idea of not knowing and just jumping on any hype stock because you just heard about it somewhere, or not knowing the companies that you're buying into, or not knowing why you're doing some of the things that you're doing. That is where the risk lies. It's not in the price of the market going up and down and up and down and up and down. What does that matter? It's going to fluctuate. That's the whole point of the market. Like I said, it's all about sentiment. And human beings, we change our emotions quite regularly. And so the market going up and down is not the risk. The risk is you not knowing what it is that you are invested in. So these are 9 of the myths that we all need to get over and we all need to do away with in order for us to actually build wealth over time, in order for us to actually get to the goals and the destinations that we have for ourselves. One of the questions that we always got to ask ourselves is, what are my goals and how am I moving towards those goals? Does this impede or does this hold me back from reaching my goals? But anyway, that's all I got for y'all. I hope y'all learned 1, maybe 2 things out of this entire thing. And if you did, hit that like button. If you loved it, hit that subscribe button. But I'm gonna catch y'all up in the next one. Remember, generosity is always greater than greed. God bless each and every single one of y'all. And your boy is out of here. Peace.